Welcome to the Finance Fools. I'm Matt.
And I'm Dan. This is episode 5, and we'll be talking about mortgages. Now, I've never bought a house, and Matt has more experience in this than I do. From the last episode, we talked about owning and renting. So, Matt, what can you tell us about mortgages?
The big thing for mortgages is for every person in every situation, what works best is different for everybody. With a mortgage for me, I might prefer one aspect of it, and you might like a different thing with a mortgage. What I mean by this is this. I might go a 15-year. You might go a 30-year. There's money down and, no money down mortgages. There's all these type of different things. There is a lot that goes into mortgages. So it's a very, very broad subject to be able to talk about, but to be able to just kind of summarize a few things that go on with mortgages, I'll start like this. So if you're a veteran, you can qualify for a VA loan, which is no money down and no PMI. PMI is short for private mortgage insurance. With private mortgage insurance, what that amounts to is you don't have 20% down for a loan. And so since you don't have that, you have to pay an additional fee that is basically an insurance for the lender. So that way, if you were to default on your loan, they have extra money to help them recuperate or recoup some of the costs from selling your house after it would go into foreclosure. To me, I think it's kind of a terrible fee because here you are, you can't afford 20% down, and then they're charging you a fee because of that. And, it really sucks. I've paid it on 2 houses that I've owned. And on the second house, the way that I paid it is I actually prepaid all my PMI. I had put 10% down. And so I was going to have just a small amount of PMI until I had 20% equity in the house. So I was going to have just a small amount until I got there. So the way my lender worked it was I was able to just pay the amount that I would have paid until I had 20% equity. And with my mortgage amount, I paid about $1,100 or so up front, and then I didn't have to deal with PMI. So with PMI, it's a payment that gets added into your loan, but then on top of that, it's also a percentage of your mortgage value in the very beginning. So say on a $100,000 house, if you have to pay a 1.5% upfront fee for PMI, you're looking at $1,500 as an upfront fee. But then because banks are so great, and that's with a lot of sarcasm, then you're paying about 0.5% each month for the amount that you're financing until your loan is paid off. So that ends up on a $100,000 mortgage, you're paying about $500 a year on top of your one-time upfront fee of $1,500. So that's about $41.67 a month every month until your loan is paid off or you refinance your mortgage. So the way that I did mine, instead of having to pay all that, $1,500 up front, that's huge right there. And then the monthly fee on top of it, I just did a smaller upfront fee of paying it off, prepaid. And it's an insurance policy, basically, how I did it. But I saved myself money long term from not having to do that.
Now, did you do this on both of your houses?
No, I did it just on the second house. On the first house, it wasn't an option to do that. At the time, I bought my first house in 2007, and 2008, 2009 is when the housing crunch hit. And so after that, laws changed and everything like that. So initially it wasn't an option. The second time around, it did become that way. But so, whenever you're having to do that, you have your upfront fee and then your monthly fee. So that's costing you money for insurance that you're never going to use, and you get nothing out of it other than a tax deduction. To buy a house, if it's $100,000 and put $20,000 down, that's pretty tough for anybody to do. So a lot of people have to deal with PMI initially. But when you go to refinance your house after time, if you've hit 20% equity in your house and then refinance it, then you can get it so on your next loan, your new loan, that you won't have that in there. And that's what I did on my first house. When I refinanced it, then I was able to get rid of that PMI, and that saved me. That's money that I didn't have to pay each month on the payment. Like I said, that you get absolutely nothing out of. So basically talking about the PMI, obviously you don't want to pay it, may happen, but VA loans are an option of nothing to do it. There's also rural loans that are partnered up with the USDA. And if you went to a small rural area and meet the income requirements, they'll have zero down, but I believe that you will pay PMI though. Same thing with HUD housing, that is through the FHA. With that, you'll pay 3.5% down as a bare minimum, but there's also bond money that you can get that can cover your 3.5% down, but you will be paying PMI unless you hit that 20% threshold. That's with pretty much any loan that you're going to have. There's conventional loans, there's conforming loans. Conventional loans are basically, they're not backed by the government. Where you might be able to avoid PMI depending upon your money down and the bank's terms, but a lot of conventional loans will be for a mortgage with, say, like a smaller or a more local bank, and with them, they will keep that they'll keep that loan in-house as opposed to sell it. With conforming loans, a lot of them are loans that, say, Bank of America or whatever lending company gets, and then they turn around and put it in a big package. It goes to Wall Street and ends up as part of an investment package. So they have certain things that you have to hit, requirements to qualify for that loan. But if you get a smaller bank and they keep it in-house, you can get better terms. And like I used Quicken Loans for my refinance on my rental house. And with that, after using a smaller local bank, I'll never use a big lender like Quicken again. I'll keep it smaller because they're way better in my opinion. But everybody, that's one of the things I always try to push on everybody, is that everybody's situation is different. So if you break down a mortgage payment, and we're going to do $100,000 at 3.75%. So for 30 years, if you were to do that, that's a $463 payment. That is covering principal and interest. So principal and interest, they adjust each month. And with that, you get, each month you'll start getting more and more principal and paying less and less interest. It'll take a long time because 30 years, 12 months per year, you're looking at 360 payments. So with time, you start getting more and more principal or equity in the house. But that $463 payment is just principal and interest. You still have, potentially your PMI on top of that, which we talked about that earlier. That was $41.67. And then, say for example, if your property taxes are about $1,600 a year, well, that's another $133 a month you have to add in to your payment. And then for your homeowner's insurance, say that's about $1,200 a year. So that's another $100 a month on your payment. So you're looking at $737.67 a month just for your payment. When you break that down, your equity that you're going to get, a little over $100 a month in the beginning. So you're like, man, that's a lot. But whenever you look at some of the rent that people charge and the fact that you get the tax deduction and you're getting equity over time, it can be helped out, it can help you out and be good for long term.
Okay, so you've been talking about this PMI. You gave us this breakdown. So what are all the different kinds of loans I could look into using?
Well, there's a lot of different loans, and also it's really the terms of the loans. With the different ones, the most common loan is a 30-year fixed rate. There are also a lot of folks that will look at 15-year. But you can break down 10 years, 15 years, 20, 25, 30. Those are the most common loan types. But then also there are loans that are called ARMs, or adjustable rate mortgages. And with them, not a lot of people do them, but they could be beneficial. And one of the things is that, so adjustable rate, they'll do them for like 3 years, 5 years, 7 years. And so if you ever look at them and you see that it has like that number, 3, 5, or 7, and then there's a slash and then it'll say 1. The 1 is how much, like how frequently it will adjust. So every year it will adjust. So if it was a 3 and 1, it's a 3-year adjustable rate mortgage that will adjust every year one time. And then afterwards, it's just whatever the payment is that the bank will give you. And it's based on the LIBOR rate, which that's a lot to go into. But overall, with adjustable rate mortgages, the benefit of them is you can get sometimes you can get a lower rate than a fixed long-term loan.
So the adjustable rate, like the 3 and the 1, is in 3 years it will adjust one time, and then it's like a fixed rate after that 3-year period?
So the way that it'll work out is the first year you'll have a fixed rate, and it's X amount percent in payment. And then after the first year, it'll readjust for the second year, so that you have another year of consistent payments that are at whatever rate it's adjusted to for that time frame. And then the third year, at the beginning of after 2 years when it adjusts, it'll adjust for the final third year. And then after the 3 years are completed, or 5 or 7, depending upon what arm you chose, then after you're done with the time frame that you picked out, then each month it'll fluctuate instead of just once a year. So with that, then you have a payment where you never know what the rate's going to be or the payment's going to be, because it adjusts each month until you refinance and pick out a loan that is either another adjustable rate for whatever term or a fixed rate. So in conclusion, when you're looking for a mortgage, the biggest thing to think about is comparing apples to apples. If you look at a 15-year, and that's what you're going to do for your mortgage, and you're shopping around, compare the 15-year to 15-year or 30-year to 30-year, whatever it is. Look at the end of the loan. What is the final cost? Because you'll have fees from the mortgage broker and the bank and inspections and all that kind of stuff. Basically, on the paperwork, at the very last thing that you're looking at, how much does that loan cost? And then that can kind of help you pick out a loan, because if you're looking at a $100,000 house and one mortgage, as soon as you get done paying it off, is $175,000 and the other is $165,000. Overall, if you're saving $10,000, then that other loan's probably the way to go.
All right, awesome. Thanks for all that great information, Matt. I would just like to thank our listeners for tuning in. And remember, if you enjoyed this episode, like and subscribe. Don't forget to follow us on Facebook, Twitter, and if you ever have any questions, email us at thefinancefools@gmail.com. And as always, plan your work your plan. Tune in for more from
The Finance Fools.